Welcome to today's Financial Insights in Minutes, where we condense the latest market news for you. With the economy change looming, we'll evaluate critical warnings and expert opinions in today's episode.
Get ready as we dive into deflation concerns, recession indicators, and social unrest risks.
This video is packed with expert analyses. Let's see what our guests have to say.
Buckle up for insights from Darius Dale, Jeff Snyder, and more as we explore the financial landscape.
First, Darius Dale reveals the shift from growth to potential deflation in markets. Next, Jeff Snyder points to worrisome indicators hinting at an upcoming recession. Sir Paul Collier discusses the risks of social unrest linked to rising inequality. Matt from Trade Brigade cautions that the market could be in a bull trap. Sven Henrich discusses the volatility hitting the markets and its implications. Jason Shapiro shares the principles of loving trading beyond just profits. Joseph Wang covers the market's reaction to global events and labor adjustments. Lastly, Mott Capital warns of potential chaos surrounding the upcoming CPI report. Welcome back to Thoughtful Money. Today, we're charting turbulent waters as we discuss the shifting tides in the economy and asset markets. Joining us is our insightful guest, Darius Dale, founder of 42 Macro, who has been spot on with his previous forecasts. Get ready for an in-depth analysis.
Absolutely. Darius is here to decode the ongoing debate between growth and deflation affecting markets globally. His expertise on market regimes is essential for navigating these uncertain waters.
So, Darius opened by saying that the economy is currently at a crossroads, right? What's the core thesis here?
Exactly. Darius points out that while the U.S. has experienced uninterrupted growth since mid-2022, there's a shift underway as inflation and growth rates start to decelerate simultaneously, suggesting a troublesome transition to a deflationary environment.
Let's break down those key points. First, what's happening with our economic climate?
Darius emphasizes that the economy is shifting from Goldilocks conditions to a phase where both inflation and growth may be faltering. It's an intricate dance of market sentiment.
Now, what about the market regime? What does Darius say?
He states that we're observing a shift from a risk-on environment where investors are eager to a risk-off sentiment, prompting a reallocation towards bonds and safer assets.
And what about those predictions?
Darius remains cautiously optimistic, believing the growth slowdown won't be as severe as many predict, yet he warns that inflation could re-emerge, leading to risks down the line.
What's Darius foreseeing in terms of market predictions?
He predicts short-term market volatility, but emphasizes the importance of positioning portfolios to withstand these transitions effectively.
And what about the longer-term shifts?
Dale warns that if inflation begins to rise again without a corresponding growth in the economy, it could lead to real complications for investors.
To wrap this up, what should viewers really take home from this discussion?
Darius stresses the need for strategic caution and focus on identifying risks ahead of time. Being prepared for changes in economic regimes is essential for navigating these turbulent waters.
Welcome to Eurodollar University. Today, we're diving into a troubling warning sign from the stock market that's been spotted only 3 other times in 35 years. Joining us is our resident economic guru, Jeff Snyder, who leads us through this financial storm.
Absolutely. With his deep knowledge of monetary policy and the intricate workings of our economy, Jeff reveals critical insights that everyone needs to hear before it's too late. Let's get straight to the facts.
So what's the core thesis we're unpacking today?
The thesis centers on the alarming signs emerging from economic indicators like the copper-to-gold ratio. This warns of significant underlying issues despite the stock market's surface-level recovery.
Let's break down the key points. What's the real story behind these stock rebounds?
Historically, stock market spikes often occur right before downturns. The recent increase doesn't mean recovery, but rather a temporary lift that masks deeper issues.
What are these troubling economic indicators you're mentioning?
The copper-to-gold ratio just hit its lowest level since the 2008 crisis. This signals weakness in the economy and aligns with historical patterns that suggest a potential recession.
And how do interest rate swaps fit into this mysterious puzzle?
Interest rate swap spreads continue to decline, hitting record lows. This indicates significant fear in the market and suggests more recessionary pressures ahead.
So what's in the crystal ball? What does Jeff predict?
The predictions lean towards an impending economic contraction. With limited upside and rising jobless claims, a recession seems more likely than a robust recovery.
Are we in for a bumpy ride ahead?
Absolutely. The market's euphoria contrasts sharply with the reality of declining economic indicators. It's a storm brewing, and optimism may quickly fade.
As we wrap up, what should viewers take away from this discussion?
Key economic signals suggest a potential recession ahead despite the stock market's recent upswing. It's crucial to stay informed and critically analyze these indicators for better decision-making.
Any final thoughts for investors navigating these choppy waters?
Investors should remain cautious and heed these early warning signs. Staying aware of the underlying conditions is essential to avoid being caught off guard.
Welcome to David Lin's channel. Today, we dive into a thought-provoking discussion with Sir Paul Collier on the potential for severe regional conflict over the next 50 years.
Absolutely. Paul is a renowned expert in global conflicts and civil wars, and he has some intriguing insights into historical and contemporary issues shaping our world today.
So, what's the core message from Sir Paul's insights?
He argues that the existential conflict between America and China could lead to a protracted period of regional unrest, influenced by social inequities and internal divisions.
Let's break down those key points. What's the deal with rising inequality?
Sir Paul highlights that wealth concentration in the hands of a few fosters anger and resentment among the underprivileged, potentially nurturing social unrest.
What about the idea of civil unrest or even a civil war?
While unrest is possible due to dissatisfaction, Sir Paul asserts that America's fractured society is more likely to result in small-scale conflicts rather than a full-scale civil war.
How do global power dynamics play into this?
The ongoing tensions between the U.S. and China are central to this discourse, with Sir Paul suggesting that a centralized authority in China may falter against a more decentralized U.S. structure.
What does Sir Paul predict for the future?
He foresees ongoing regional conflicts, primarily influenced by U.S.-China tensions, which will shape global geopolitical landscapes for decades.
And what about civil unrest outcomes?
If significant action isn't taken to address societal issues, we could witness growing discontent and the rise of extremist groups as desperate people seek solutions.
As we wrap up, what are the main takeaways?
To mitigate the threats of conflict and unrest, it's crucial to address the root causes of inequality and foster inclusive economic opportunities across all regions.
Welcome to the Trade Brigade Weekend Show. Today, we'll dive into the latest market analysis. Is this just a bull trap, or is there a real opportunity?
Absolutely. Matt guides us through the current bearish outlook and what it would take to change that perspective. Buckle up.
So what's the core thesis Matt is presenting?
The emphasis here is on maintaining a bearish outlook, while also exploring what could prompt a shift towards bullish sentiment.
Let's break down key points. What's the current status of market trends?
Short-term, the market is bearish. However, if we zoom out, the long-term trend remains upward, providing hope.
What about those key resistance levels?
Resistance at around $550 is crucial. A close above here could signal a bullish turn.
Fibonacci levels can offer insight too. What did Matt discover?
Absolutely. He highlights that a rejection at the 38.2% Fibonacci level may reinforce the bearish stance.
Looking into the crystal ball, what predictions does Matt have?
If the market manages to close above $550, it could trigger a bullish outlook.
And how about the broader economic impacts?
The upcoming CPI report will be a key player in shaping the Fed's future decisions, influencing market direction.
Wrapping it all up, what are the main takeaways?
It boils down to patience. Watch for key resistance levels and various market indicators before trading.
Welcome to NorthmanTrader on YouTube. Today's thrilling episode dives into the tangled currents of the market, titled Hammered. What a whirlwind week we've just had.
Absolutely. Our insightful guide, Sven Henrik, highlights the dramatic shifts in market sentiment. With his expertise in trading and macroeconomics, he's uniquely equipped to guide us through these choppy waters.
What's at the core of Sven's analysis this week?
The thesis revolves around last week's remarkable spike in the volatility index, indicating significant market instability. Despite the rapid uptick, traders must remain vigilant as the market's reaction could lead to further changes.
Let's break down the major points. First up, that VIX spike. What's the scoop?
We witnessed the third largest VIX spike in the last 15 years. Quite the market surprise, wouldn't you say?
Now, regarding those technical indicators, what did Sven reveal?
Sven highlighted key trend lines and gaps that were due for fills. Despite the chaos, these technical signals held significant weight.
What about the challenges facing the market?
Exactly. The small caps hit major resistance, causing a significant drop. Without strong fundamentals behind these buybacks, the market might struggle.
Sven hinted at economic signals. What did he find?
He noted that despite the storm, there was a surprising stability in junk bonds. This could signal an unusual market resilience.
And what should traders be looking out for?
Sven pointed out that the upcoming CPI report and events like the Jackson Hole meeting could shake things up further.
Now for some predictions. What's on the horizon?
Sven suggests that as volatility settles, we might see a rebound, but without solid support, new lows are certainly on the table.
Does Sven draw any historical comparisons?
Yes, he draws parallels to market behaviors from past years, suggesting current patterns may lead to future recoveries.
To wrap up, what should traders take away?
It's essential for traders to stay cautious and informed, particularly as market dynamics shift. The roads ahead may be uncertain.
What does Sven emphasize about upcoming events?
He stresses the importance of keeping an eye on monetary policies and market events, as they could greatly influence trading decisions.
Welcome to Crowded Market Report. On today's adventure, let's explore a question many trading enthusiasts ponder. What does it truly mean to love trading?
Exactly. Jason Shapiro, our insightful guest and founder of Crowded Market Report, digs deep into the passion behind trading and what it really takes to succeed.
So, what's the primary takeaway from today's discussion?
The core thesis is that truly loving trading means being committed to the hard work involved, not just the thrill of making profits.
Let's jump into some key points. What's a common misconception about loving trading?
Many think they love trading simply because they enjoy making money. But true love for trading is rooted in commitment and hard work, not just profit.
And what about improvement? How does one get better at trading?
Jason highlights that improvement comes from consistent practice and accepting that mistakes and losses are part of the journey.
Now, how do traders build their success?
Creating a trading process is essential. This involves analyzing failures to understand why certain trades did not work out.
Looking ahead, what predictions does Jason make about trading?
He predicts a growing interest in trading as people look for independence, emphasizing the need for strategy and education to support this passion.
To wrap things up, what should aspiring traders take away?
Truly loving trading means committing to hard work and continuous learning. It's not just about profits, it's about the journey.
Welcome to the vibrant world of Markets Weekly. Today, we're diving deep into an eventful week marked by market turbulence. Buckle up as we navigate through some highs and lows.
Absolutely. August 10th brings some hot topics to discuss, including chaotic market actions, the Bank of Japan's rate decisions, and intriguing labor market shifts post-pandemic.
So, what's the big idea behind this week's episode?
At its core, this week reveals how market jitters manifest as traders react to data and central bank decisions, especially coming from Japan.
Let's talk about that market chaos. What led to such turbulence?
The Japanese market dropped 12%, causing a ripple effect globally, pushing the S&P down 3%. Plus, we saw volatility skyrocket, with the VIX peaking at 60.
And what's going on with the Bank of Japan?
They raised rates to 0.25%, but quickly pivoted due to market reactions. This was viewed as a dovish signal, easing some market fears.
That's fascinating. Now, what about the labor market insights?
The New York Fed reported significant internal migration trends affecting job demands, with more positions in healthcare and less in tech, reflecting changing city populations.
Future gazing now, what can we expect looking ahead?
We can anticipate ongoing volatility. As markets adapt to the new economic landscape and central bank communications, things are bound to alter again.
Any predictions about the job market?
Yes, a surge in demand for healthcare positions is expected, especially in those medium-sized cities that are experiencing a population influx.
So, let's wrap things up. What movements should we be mindful of?
Overall, the week's market turbulence is indicative of significant economic adjustments. Keeping an eye on job trends and central bank policies will be crucial for the future.
Welcome to Mott Capital's Market Chronicles. Today's big question: could the upcoming CPI report be a disaster for the market? Hold on tight, because we're diving into some heavy economic waters.
That's right. The CPI data is crucial for understanding inflation's effects on our economy. With a collapse of figures looming, let's get straight to the facts.
So what's the core thesis here? What are we really worried about?
The crux of the discussion revolves around the CPI report slated for release. Expectations suggest a potential disappointingly low result that could shake up multiple asset classes. The market is on edge, hoping inflation numbers will come in cooler than before.
Let's break down some key points. What are the expected numbers for the CPI?
Analysts are looking for a 0.2% increase month over month for the upcoming report. That's up from a previous negative adjustment. Year on year, we're pegged at around 3%.
What's the vibe in the market heading into this report?
The swap markets predict cooler results, reflecting significant uncertainty across assets. If firms are right, we may witness major shifts.
How do these expectations affect interest rates?
If the CPI disappoints, that might strengthen expectations of Fed rate cuts, especially for two-year rates. It's a real balancing act.
Time for some predictions. What could happen following the release of the CPI data?
A negative miss could lead to an uptick in interest rates and a stronger Japanese yen, both of which could negatively affect U.S. equities.
So, what's the final takeaway from all this?
Monitoring the CPI report closely is essential, as it holds the potential to dictate future market trends and alter investor sentiment. Staying informed is key.
Today, Darius highlights the crucial transition towards a deflationary market, emphasizing a need for strategic caution and portfolio adjustments.
Jeff warns about stark economic indicators pointing at a looming recession, echoing Darius on the need for vigilance.
Sir Paul uncovers risk factors related to social inequality, linking it to potential market instability, resonating with concerns raised by our other guests.
Meanwhile, Matt reminds us about the dangers of market traps and emphasizes the importance of staying bearish until we see a convincing bullish shift.
Thanks for watching Financial Insights in Minutes for August 11th, 2024. If you'd like more time-saving content, please remember to like and subscribe. If you have ideas for more channels you'd like to see summarized, drop a comment below. See you next time.